Good evening, everyone. Welcome to our webinar at binary.com. We're going to take a look at the trading strategy in detail, and I think this is going to be a very exciting and interesting webinar for you, because I think strategies are always the most interesting for traders, and that will never change, I believe. So before we continue, though, in more detail regarding the strategy in detail, the risk disclaimer explaining that trading global financial markets is considered high risk and may not be suitable for all investors. Please seek the advice of an independent financial advisor for more information on that. And this webinar is for educational purposes only. Please read this entire disclaimer at your own leisure, and I thank you for your attention on that. Alrighty. So today's goal, we're going to take a look at actual trading strategies, some trading ideas, when to enter, what kind of time frames to target. And as a special bonus, for those of you who are joining or looking at the webinar, that's great, first of all. And because we're glad that you're here, there's a special bonus of 20 by inserting the code 14546F20. And you have to fill that in the bonus field on the account opening form that is intended for those with no account or virtual account or a real account but have not claimed the bonus. But for those who have, there's a spelling mistake at the bottom, but for those who have a real account and have claimed the bonus, you will be contacted within 24 hours after the webinar. All right. So I think that's an exciting start. In any case, think about it, write it down. It can't hurt to have it on paper at least, and think about it. Maybe you'll find it interesting. If not, no problem at all. But I think it's a interesting incentive. So I'll just give you a few seconds there. I'll show you the number again, the code again at the end, just in case you want to check that. It's 14546F20. All right. So if anyone still needs that code, tell me. Otherwise, I will move on to explaining what we'll be looking at today. Basically what I'm going to show you here is a strategy, or various methods, in fact, of taking and entering a trade. And that could be, basically, I trade Forex, so I will use Forex many times as an example. But this is basically universal concepts. And you can see, highlighted by orange letters, the types of entries. They're basically groups of entries, right? An early entry, a confirmation entry, or momentum entries. What it basically says is that an early entry, you're basically trying to pick a particular level in the market that you think is going to be key, so key that it will be a turning spot. So for example, the market is moving up and is nicely making that upside momentum like this. I will use green as a color. But there is something on the chart that makes you think, hey, that could be a top level. We're not going to break that. Those kind of levels are typically tops and bottoms, major support and resistances like trend lines or Fibonacci levels. Those merit an entry right there, right now, right? For example. But you can also wait for a confirmation. If you feel that a certain trade idea doesn't warrant or merit a particular early entry, immediate entry, you can wait for the market to confirm the respect for that level. So instead of taking a direct entry at that level, wait for price to get to the level and look for a confirmation at that level. That confirmation could be a candlestick formation, for example. If you see a huge wick right at that level, like this, right, indicating a lot of selling pressure, for example, I should use red probably, but you get the picture, then that is a confirmation that price is respecting that level, and you can use that as a confirmation of entry, right, instead of the direct level. The other is the momentum entry, and that's basically when really the steam in the market is already moving a lot, either dropping or rising a lot. So the momentum entry is catching kind of a top or bottom. The confirmation is an entry when we already had confirmation, in fact. And a momentum is when it really gets rolling a lot, right? So there are different stages. If you look at, for example, an up move, price is moving up. The entry is trying to catch it at the top. The confirmation is when you have the confirmation of the top. And the momentum is when the price keeps moving down and you're trying to catch it more at the lower part of that down move. All right. So the top one is the early. I'll put an E there, then the C, and then the M. Now, obviously, if you look at this schematic, you can see that the momentum entry, you're already getting closer to a potential bottom. Right? So there's less space left. So you have to be aware of that. That the momentum, you have the most confirmation, but the least kind of space in a way. All right, the confirmation is in between, and the early is you have a lot of space for that potential move down, but you're trying to pick a top, and in some cases, picking a top or bottom doesn't work, and the price does this instead of the turnaround. So it's riskier. That's the opposite side of it, right? It's always a double-edged sword, and it depends on situation to situation in the market which one is more appropriate. Now, things you can look at to decide which is more appropriate is, for example, using trend definition. If you're trading with the trend, using a momentum breakout, for example, is definitely justified, right? Because you are trading with the trend. If you're trading some reversal type of situation, you might want to try an early entry, because that could be the only way you could attempt to catch that reversal, or it's at least the safest way of attempting to catch a reversal. Just an indication there. Let's continue and give some practical examples. Let's make it a bit more real and less theory. This is the pound-dollar 4-hour chart. Pound-dollar 4-hour. And what you can see here is a trend line indicated by the black line. And basically, where you see fib at the very top, where I will draw a green box, that was a key level that I identified. Now, how to draw fibs, that's going to be a different story. That's a different webinar. We actually had that already. If I remember correctly, I think we did talk about fibs. But you just basically draw from one level. You take one high, basically, and draw it to the next low. Very simply put. All right, but it's a bit more complicated than that. But and there's a Fibonacci level, and a Fibonacci level is just a retracement level. That's a key level. So that could have been an entry, for example, right at that fib level. But you can see that this one is a perfect example, because that's where the price exactly turned. That not always will happen, of course. Price can go through that fib level and not turn exactly at that level. So you're taking a risk there. The next method would be the confirmation, which is the engulfing 4-hour Japanese candlestick twins here. The red candle is totally engulfing, overpowering the small blue candle, indicating a lot of selling pressure. That is a confirmation of price in the market seeing that major fib level and reacting to it. So if you wait for that, then you would enter the market upon the confirmation of the candles. If you're looking for a momentum entry, you would draw this trend line and wait for a break of that trend line, right, or bear flag. And that break would be here or here, right? Two potentials. You can wait for the break of the trend line, or you could wait for the break of support, which is this level right in here. This is, by the way, a fractal indicator for those of you who are wondering. It just shows tops and bottoms. That's all. And indeed, we get a move. But as I already said, the down move then rolls out and eventually doesn't last forever, finds support, and then does the opposite. You will see these ups and downs as a natural movement within the market often. right? It's a natural psychology. So you will see that on all time frames, on all levels, these ups and downs. Nothing moves in one straight go forever. It did move decently to the downside for a period, right? And we had candles that had lower lows and lower highs, looking at these candlesticks, right? Nicely moving down, but eventually we stop and then make bullish candles. But the funny thing is, if you put a fib now from this top to this bottom, the currency stopped again at a particular fib level. I think it's probably the 50 fib. And that would have been a potential entry for a level trader, right? But if you're looking for a confirmation pattern or signal, then look at this big wick, right? Huge wick, a lot of selling pressure. That would have been your entry signal for confirmation, right? Right there, after you see a wick like that. Alrighty, so now that you know a bit about entry methodologies, basically what it all boils down to is us as traders, you want to do 5 things. You want to identify the trend. You want to identify what is the opportunity. Are you waiting for a break, a pullback? You want to check if there are any filters, anything that could block the trade from materializing. So trend, what is the opportunity? Are there filters? Then you want to take a look at what is the exact trigger. What are you really looking for before you could think about entering? And then, last but not least, the exact way you enter. Because funny enough, you might say, okay, I want price to go through this level as a trigger, but it doesn't necessarily mean you must enter at that particular spot. You can still look at the entry methodology. And that's what we're discussing now, or just discussed, with regard to looking for confirmation, a break, momentum, basically, confirmation, or direct level. So it's this TOFTE, TOFTE for short, right? These 5 steps. Alrighty. So this particular strategy is a 4-hour oscillator. We're using the 4-hour chart, and what we're looking for, it's a very simple strategy. What we're looking for is a strong AO directional guidance. And I'll show you what the AO is. It stands for Awesome Oscillator. So it's a particular indicator. And what we're looking for is a retracement back to that 0 line. So let me show it to you. On the bottom is the AO, and it's called the Awesome Oscillator. You can find it by going to your, and you would need a MetaTrader 4 or another software program that you can use for charting. All right, and you would go to Insert, Indicators, and you can go to Bill Williams, Insert, Indicators, Bill Williams, and then you'll find Awesome Oscillator. And what we're looking for here is a strong AO. So that means you can see at the bottom, we're looking at the bottom, right? Just in case. The black arrows. And those indicate that, these are strong moves down. Now, strong is relative, but you want to compare these levels to each other. I mean, obviously the first one is stronger than the second one, right? This one is stronger than these. So a strong, you want one that's relatively sticking out compared to the others, or at least a decent move. You will get the feeling for that very fast when you look back a few times. You'll quickly understand which is strong. What you then want is a move back to the 0 line. That's very easy. The 0 line is right in the middle. That's the 0 line. It's halfway, usually, right? It's just in the middle, 0. So you want a strong move down, and you want that oscillator that indicated to go back to the 0 line. Now, that's all. And then it's up to you how you enter. Once that has happened, you can take a direct entry level, confirmation, or breakout. In fact, the breakout is, for example, as I said, a break below the 4-hour fractal, which is also a Bill Williams indicator. And if you enter there, there's a very good statistical probability of going 1-to-1 on that trade. All right. Now that is not so useful when you're looking at time factor, right? Which is what we're doing with binary.com. So in that case, you want to on 4-hour charts look typically at anything around, you can see here upon the entry you had approximately 4 down, another 8 correction, another 4 down. So you would typically look at something around 4 and 8, and then another 4 down. Yeah, anything between 12 and 24 candles, that is, right? Candles would be typically the most safest zone, because even if you get a correction like this, that typically doesn't last longer than that before you get a continuation. Here are other examples, black circles, where price has gone through to the zero line, right? Like that. All right. What you typically want to see here, you can see when we break this 4-hour support, that's when we start to move down. All right. And this is an example for upside. And we get that upside. You see that? So it's a very simple strategy. It's no bells or whistles here. But this particular strategy, as I said, is the break of the 4-hour fractal, although there's nothing wrong with taking an early entry or a confirmation entry. But this is waiting for the breakout of the 4-hour fractal, a break of the 4-hour fractal. Okay. Let's see. This is the same example, in fact, but now looking with more emphasis at that oscillator. And you can see that the oscillator is way back here, up above the zero line, indicating the retracement is finished, and we can continue to the downside. Right? And the confirmation, the breakout we're waiting for is below this 4-hour fractal. So it's very simple. All you need is an oscillator and a fractal, and you can already implement it. It cannot get simpler, in fact, than this. This is one of the simplest strategies out there. All right. Here again, you have the black circles indicating the bar, the histograms back to the zero line, and those are opportunities in this uptrend. This is the dollar yen, and look at that opportunity you have when the oscillator is back to that zero line. Every time it's back to the zero line, it's ready for the next up move. And it's great potential. But you do need to make sure that the oscillator is a strong trend, a strong move up. All right? That's very important. For those of you who don't hear me that well, apparently, I don't know, is there anyone else that has the same problem? I would not know what the issue could be, to be honest. Let's hope that it's okay from now on. All right. Otherwise, we definitely have the recording as well that will be released soon. Alrighty. The breakouts. This is a different strategy. Now, first of all, if you have any questions regarding the former strategy, let me know, and I'll take a look at that. Okay? No problem at all. This is a separate and a different strategy, and it's a breakout strategy. Basically, we're looking at a trend on a 4-hour chart. All right. Now, the trend definition is simple. Now, it's not always easy to implement that, but it is simple. it is always looking for higher highs and higher lows. So you have this type of price motion, right? That's the classical definition of an uptrend. The opposite would be true for a downtrend when you have lower lows and lower highs. I'm sorry if I bore some of you with something you already know, but I want to make sure everyone's on board here. All right, so I want to check even those who are, or maybe do not know this, for example, want to make sure that everything's clear. So that is the classical definition of a trend. Now, where does it get messy and sometimes a bit more complicated is when price does this. Right? That, of course, is a choppy move, which means a lot of sideways price action. There's no clear trend. Yes, we make some higher highs, we make technically maybe a lower low, but there's no direction. If there's any, it's going sideways, and it's a range, which means the tops are more or less equal of level and the bottoms are more or less equal of level. This is not a trend. Therefore, this type of price action would not qualify for this strategy. The first requirement is that we have a trend. That's also, in fact, true for the oscillator strategy we showed, or I showed just a few minutes ago. The funny thing about that strategy is that you really only have to look, in a way, only have to look at the oscillator. So it's made simple, but if you use the trend definition for that oscillator strategy, that would be perfectly fine as well. So what do we need next? Once we have a trend definition in play, we have, for example, an uptrend, what we're looking for is a pullback on a 1 hour chart, which means a move down counter the trend. Right? If it's uptrend, we're waiting for a move that's kind of like doing like this to the downside after a strong upside within a trend, right? With higher lows. All right, that's a pullback. Next is a break of a trend line. So when you have an uptrend and you have a correction, what you can do is put a trend line connecting these tops like that and wait for price to go through it. Once it does, that is one of those momentum breaks. In fact, this is an example, in fact, of a momentum break. Then there's a high likelihood of the currency continuing with that uptrend and doing something like this. All right, and you have up, correction, up, or downtrend, up, correction, downtrend. This is statistically the safest way of trading. And it has everything with the fact to do with the fact that we are, in this case, or I am trading with the trend. Now, always there is a probability, nothing is 100%, that the up move and continuation is a false break. And a false, why false? Because it gets rejected at this top, for example, and you see one more down move maybe before you see up. Right? Always possible. Nothing is a guarantee, nothing is 100%. But statistically, it's a high probability, and there's a good chance that it does continue. Because why is that so? Because other traders recognize the breakout, and that pushes price to the upside. And you have that high likelihood of continuing to higher ground. So here too, I'm looking for to enter upon the break of that fractal. And take profit could be anywhere. Basically, if you use less candles, that could work. But the problem is that sometimes the currency doesn't move as fast. And if you target 2 or 3 candles, the currency might move and break out later on, and you could take a loss if you end your trade within 2-3 candles. So 6 to 9, yeah, I would say is the sweet zone there. If it's too much, more than 9, then, well, then in some cases what could happen is that, yes, you do get a continuation, but after more than 9, you already get a retracement after that, right? And that wouldn't be good because then you were doing well, and it would be a shame if you aim for too high of a time there. So let's take a practical example of this pound dollar 4 hour chart. And the funny thing is the exact same chart now, not only with the oscillator, but adding the trend lines. So this is cool because you can see how everything confirms and kind of makes a confluence. Now we were looking at the oscillator strategy and saying, hey, look, down at the oscillator, we see those black circles. That's when the oscillator has returned to the 0 line. So that's a potential good moment, right? Now we have the confirmation, we said, when the 4 hour fractal is broken. Although earlier entries are possible as well, right? But that was not the official strategy kind of that oscillator. But we know from the very beginning that there are 3 different ways of entry methodology. So then the price moves through those red and green trend lines that are on the chart. And when price does that, that's a typical example of a breakout momentum type of entry. All right, that's a typical one. And you can see that usually 6 to 9 candles is good. In some cases, more is also fine or less is fine. But I think in all of these cases, on average, 6 to 9 seems to be, could be, I think, in my opinion, the best. All right. So this is 1 hour chart, dollar yen. And this is only an example of the breakout trend line. All these trend lines indicated by the black line there on the black lines on the chart are breakout examples where price is moving through a trend line. Now there are some things you need to know about trend lines. Otherwise you might implement it at the wrong spot. First of all, as I said, you must have a trend. Second, you want a trend line that preferably has 3 hits on it. 3 hits. And other than that, you preferably want a trend line that is, if you're an uptrend, that is pointed to the downside. You see all these trend lines are pointing to the downside. None of them to the upside. That is better than, usually better than pointing to the upside, okay? Unless you maybe have more experience in trading. So all these breaks worked very well, as you can see. On the dollar yen 1 hour chart. So, these trend lines you can use on 1 hour, 4 hour charts, even 15, but you have to realize that the 15-minute world would be less reliable in a way than the 1 hour or the 4 hour. All right, it's just more flaky. It has more its ups and downs. It's not as sturdy as, for example, higher time frames starting from 1 hour, which is more like intermediate. 4 hour maybe intermediate, and day chart is more longer term. Here too, by the way, funny enough, if you look at the oscillator on the 1 hour chart, it's even here you can use it as a good info, right? You can use it as a interesting additional information to whatever you use. So what are examples of support and resistance that you could use to identify potential entries. Also, don't forget that supportive resistances not only are necessarily good as entries, but they're great targets as well. And there could even be used as filters. We talked about the 5 steps of analyzing the currency, right? And the 5 steps of going through whether there's a legitimate setup before you can, the 5 methods you want to take a look at. You can use supportive resistance for defining the trend, in fact, but also using it as an entry, but also using it as a filter. Right? If we're close to a top or bottom, we don't want to go long right in front of a top. We don't want to go short right in front of a bottom. All right, professional traders buy on dips, sell on rallies. They don't go long right in front of a major top because they know that the likelihood of price respecting a level at least the first attempt is very high. Second attempt decently high, and the third attempt might break. Could still be respected, in fact. All right, that likelihood is very high. Support and resistance is a key, and I cannot emphasize it more than that, factor when looking at trading. And it has everything to do with the market psychology of traders. Because everyone knows no one goes long in front of a top. That top gets respected. And the price moves down. So for example, like that, and I am talking about major support and resistances, right? You have to be aware that on all time frames there are support and resistances. You'll have to ignore some of them, ironically enough, to be able to trade, because otherwise you'll see support and resistances everywhere, and wouldn't help you. So what you want to do typically is use a particular time frame for your entries. For example, the 1 hour. Use one time frame for your trend, which is typically 1 or 2 time frames higher than your entry, like the 4 hour. And then use filters, either the same or one time frame higher, which could be the day chart. So I'm not talking, if you're entering on the 1 hour chart, I'm not talking about support and resistances on the 1 hour chart. Those definitely have an impact, but it's not something I would necessarily base, a filter and say, okay, I'm not taking that trade because of support and resistance close by. All right? Those are tops and bottoms. Highs and lows are support and resistance. Fibonacci retracement and targets, trend lines, consolidation zones, and patterns. Those are all examples of major support and resistance. All right? Highs and lows are always very important. Daily highs, daily lows, very key. Because the daily high or low is something that definitely gains respect from the market, just like weekly highs and lows. Fibonacci retracements, targets, absolutely. Trend lines, definitely. Consolidation zones, yes. What happens is that, for example, if you have an up move, you see a big zone like that, and then you see a break, that whole thing has a decent chance at these tops of becoming support in the future. Now, it's not to say that other elements could not be support and resistance if you use a Ichimoku indicator. Then that could work fine as well. But I don't use that regularly, so I don't mention that. But if you have practice with that, depends on the tools you use as well, right? But obviously, tops and bottoms and highs and lows is universal. In fact, Fibonacci retracements as well. All right, if you use trend lines or not, zones or patterns may be a bit more subjective. Maybe fib retracements as well, but tops and bottoms are very, very, very clear, and highs and lows as well. There's kind of no gray area in that regard. So let's continue and take a look at the pound dollar again here, 4-hour chart. And what happens if we put fibs on this? Well, what do you get? Top, bottom. Where did the currency stop? Right at the fib. Right at the fib here. Let me put green circles. All right. That's very useful. Fibs are very useful, but fibs are important only in trends. There has to be a trending environment to use fibs, because if you have a range and the market is bouncing up and down between two levels, then only tops and bottoms matter. Because fibs, if you put a fib between any of these moves up, the currencies are going to blast right through them, because it's going to go to the top or bottom. Let's take a look at this example. We have, for example, a trend line act as a support. Trend line where the currency broke through, but then used it as a support for upside. A trend line bounce here, or a major top and resistance. All right, and you can see the big candlestick right in here, right, as a confirmation. All right, so what would be the level trade idea? Well, that would be, you can see clearly this is a top. That would be that. What is the confirmation idea? Right at this candlestick, isn't it? What would be the momentum breakout? Well, we can connect the trend line like this, and it would be a break upon the support in here, right? So you have three spots basically upon this resistance. Next example. What do we got here? Well, we have a broken bottom. Currency moved back, used it as resistance. And let's see. Use it here as support, then use it as resistance, move down again. Then use it as resistance again, move down again, got double bottom, broke out of it, and then use it as support. You see that? What was support here became resistance here, and then became support in here again, after the double bottom. And the double bottom, of course, is caused by the fact that the currency used that particular level, that first level, right in here, as a basis for that upside. Next one. What do we got here? A lot of lines on our chart. Let's see. Well, basically, I got an orange circle here. I forgot exactly why I did that. But you can see, even though this is a support level, it doesn't break through that support level, although it eventually does, right? It still pauses there. Then we have a trend line right here. It bit the trend line, but it didn't break this resistance. Then bounced off this trend line. And the funny, yeah, this is exact same example, I think. No, this is a different example. This is the 1 hour chart, and the last one was a 4 hour. But it's funny because it's so similar, isn't it? This is used as resistance. Currency breaks through it, hooks back to the same broken resistance, now support, up to the new level. where price then uses the same resistance again as support up to the new level. Alrighty. How about daily highs and lows? What do we have here? Look at those red circles. These are all daily candles. Did I say red circles? Black circles, sorry. And look how all those highs and lows are respected. All right? You can see anytime the currency approaches a higher low, probably the entire market, in fact, most likely, you can see that that's not an easy level to push through. It causes respect for the market, right? You can see that. Price doesn't break through those levels 1, 2, 3. Right? Sometimes it does, right? Look at this. There's an example here on the right. We have a big doji with the wick on top, and price just slams through that low and keeps falling. Right? It's not always the case, but it's something that you want to be aware of at least. And in some cases, if we did break above a high or below a low, and we stay there, we want to make sure that it's not a false break. So if price stays there for an hour or two, then there's a higher likelihood of a sustainable break of that higher low. Let's move on to the next example of your dollar 4-hour chart. Look at how the currency respects this Fibonacci retracement level. It stopped at the 236, at the 382, at the 50%, the 61.8%, and at the 78%. All of these levels, price stopped at those levels. Now, some of you might think, this is a one-time thing, but it certainly isn't, and I encourage you to practice it yourself, in fact, because the thing is that anything that is ever actually explained to you as a concept, you can only really use it if you have the experience to implement it yourself, because otherwise you'll never get that translation into confidence of trading something. But no problem. If you don't like it, of course, no problem. But it works very well for me. This is the pound dollar 4-hour chart. And I'm giving an example that you want to be careful with broken. Not all the time will broken resistance become support in the future. Not all. It does depend. I don't want to make it sound that simple. It isn't. There are great examples of where broken support or resistance become the opposite in the future, but you have to be careful with that, because in some cases, if you're in a downtrend, for example, like this chart obviously is, why? Well, price is up here at the beginning and price is down here later on. And what we're looking at, for example, here is a break of this resistance and this top. Obviously, when price broke above it and then went back to that level, it didn't bounce to the upside. It just crashed and kept continuing to the downside. That's because we're in a downtrend. So you don't want to apply this in the opposite direction here. All right? Be careful of that. Just a warning. Well, folks, I can see that that wraps it up. So just to summarize, well, in fact, before I summarize it, I'll give you the summary in just a second, but I do want to mention one thing, in fact, that is this blog.binary.com / weekly trading room. We go through a live Forex market environment where we take a look at all these things and other things. And you'll hear my analysis on the Forex market, the euro, the pound dollar, the odd dollar, and XAUUSD, dollar yen. And you'll get my take on what could be happening for the rest of the week using all these methods. So if you want to have more practical implementation of these concepts, go to blog.binary.com/weekly trading room, write your name and email, and basically you'll get a invitation and email heads up when the recording is ready. It is live. You can watch it live. It's no charge. Awesome content. We're looking at price action and fibs, etc. It'll be like 20 minutes, so it's not too long. It's going to be live, but also recorded. And if you register yourself, then you will get an email warning when the recording is ready. It's live at 7 a.m. London every Monday morning. The special bonus, once again, of 20, I'll keep the page here for the moment, is 14546F20. 14546F20, okay? And once again, here's that link. So, to summarize today, basically we looked at entry methodologies, the various types of methodologies you can enter the market. Then we looked at a specific 4-hour oscillator strategy, and then we looked at a 1-hour/4-hour breakout strategy with the trend. And last but not least, we looked at various key support and resistance that you can either use for trading entries or as a filter, for example. So 4 things: entry methodologies, 4-hour strategy, 1-hour strategy breakout, and the support and resistance, which is always key in the market. All right. Now, are there any questions that I could help you with? And don't forget this blog.binary.com/weekly trading room. That's the link where you can register yourself for the recording. All right, folks. Well, thank you so much for the few questions that I received regarding the above. Once again, here's the blog.binary.com/weekly trading room. Thank you so much for your attention. And with that said, I wish everyone great trading and look forward to see you in the next webinar. All right? Cheers, everyone.